edition of ET Now Masterclass, KV Kamath says India's growth story is now on autopilot, powered by clean balance sheets and strong corporate cash flows. But the bigger shift is underway in financial services. From broking to asset management, technology is rapidly breaking legacy modes, and incumbents may be underestimating the pace of the disruption coming their way. Here's an excerpt of that conversation.
Moving on to banking, I would probably look at it in a wider space. Moving on to financial services, what is happening and what will probably happen. What is happening is visible. What will likely happen is we have to peep into the future. What has happened is the impact of digital public infrastructure and technological advancements. And these are advancements I'm talking for the 25-year period from 1996 to 2020. I'm still not coming to today. I'll come to that as a separate piece. The first 25 years or so, actually we could do a lot because we did not have to go the mainframe way. So the simple reason, we could not afford a mainframe. At the time, say, ICICI started transforming. But by the 90s, everybody had decided that the way to go is, smaller machines, digital distribution, and so on. Then came cloud. So slowly people went on to the cloud. This is by the late 2009s, early 2010s. Then came open source. Well, some of them adopted. I'm talking of the entire financial services space, the big guys at this point in time. And then around mid-2010s, 2014-15, along with the start of Aadhaar and digital public infrastructure, access to open source became more, I would say, prevalent. And that's where you see the burst in fintechs and digitechs coming up. They could now build on their own. They could take 30, 40, 50 IT professionals and build on their own. And most of them built on their own. They did not have to get anything from there. Now, the question to ask is, have the legacy players embraced that? I don't think they have. So we'll keep that aside for a moment. Then came the next layer of SaaS-based models, which again eliminated your task of using open source and building. Somebody was already building it for you. You have to now use it. Then again, reason could be that the legacy platforms are too deep and too complex for people to play around with. So legacy players, by and large, have, in a sense, yet to go beyond cloud, and there's slow transformation going on. Whereas the new course which came on, the fintechs that came on, or the digitechs that came on, post-2015, they're all native in terms of these technologies, and they have gone in. So today, I would think, of course, the regulator has to keep in mind the system, I would say, the stability of the system, and allow new players and not allow new players.
Do you think AMCs are still hanging on to that legacy structures?
See, clearly, because the whole model was designed and built in the early 2000s, and I was part of it. It was built at a time you were capital scarce, you did not maybe know the business fully, and you did not have outlets. So you used a particular model. So for example, we used the DSA model at the time. We pioneered that model. Now, if today you stick on to that and that's your way in which you will distribute products, and in parallel you have got the ability to read the customer directly, the customer is getting savvier and savvier and younger. So the disruption then happens at a record pace. So I think we are in that zone, which to me appears could quickly change playing conditions for a lot of people in the marketplace.
So, sir, in short, what you're trying to say is that the banking system may see the same mode continue because there's a regulatory guardrail protecting it. Maybe the insurance may also see the same thing. But where the regulatory guardrails are not protecting, those are going to be disrupted much more faster.
Exactly. But even within insurance, let us look at it. I would think auto and health is a direct-to-consumer business. And that's how it will be. And there are no barriers, as I see. It is whichever company gets its act right in reaching this customer base, the customer then is able to interact. That is going to be the thing. So we have broking, asset management, and these two we have talked about. Life is slightly trickier because, like a bank deposit, life money sticks for a long time. So the consumer is going to be careful, and I'm sure the regulator is also going to be very, very watchful on this. So there may be some protection. The banking sector poses a very interesting situation. But even within life, let me just take it, where it is a term product, it is my ability to deal with you and offer you a seamless, transparent service and a seamless, transparent settlement is what matters. And which is today the most seamless, transparent structure. It's an online structure. Don't you use UPI for everything that you do? Do you think twice? It goes through, and you're certain it will go through. So I would think that even term insurance is going to be a different. Where it is endowment, where you got policy, then now come to banks. Banks, the situation is interesting because you mentioned earlier that banks are now fighting for deposits. So you have a situation which is arising where they're competing with other financial products. So what is the difference? The banking product primarily was a saving product. And now the customer is saying, hey, I see some investment products there.
I need returns now.
I need returns. Now, there may be risk associated with that. I am not negating any of these things. That has to be studied. But he's saying that I need returns. My money is lying idle. And even within the banking system, you now have a possibility to say that my overnight funds go into a sweep account, which is a money market fund. And on that, I can earn more. That's already happening in the corporate world. Your current account balances are being swept onto overnight money, where a few years back, that earned the customer nothing, and the bank paid nothing. So there was clear spread on that float that you carried, the car float. The SA continues for some time, but SA is also being swept overnight. So, what I call productive deposit with a bank, on which it can earn returns, is dwindling. So it's not just not able to increase your rate of growth in annual accretion of deposits. What is with you also is, there for a very short period of time.
Well, you can catch that full conversation on the latest edition of ET Now Masterclass. But I want to switch focus